all yours. Thanks for joining us, everyone.
Thank you, Mary. Yeah, I want to welcome everyone as well. I was glad to see we had a pretty big list of people register, so hopefully everyone is joining us. I also noticed it was a pretty diverse group, so to all of you who are philanthropically spirited people, thank you so much for your generosity in our state. For those of you that are joining us as representatives of nonprofits, thank you so much for the work that you do in our state. And for any of you that are both, well, you're just showing off. So with that said, I do want to make another quick piece of housekeeping. We got a few questions ahead of time in email, questions people had related to our presentation. And, I just want to emphasize that we're going to be discussing some of the impacts of the CARES Act that relate to charitable giving. Some of the questions people had submitted were related to seeking maybe relief funding that might have been available through the CARES Act. And our intention is to follow up with you folks offline, but those topics are going to fall outside the scope of our discussion. I think you've met everyone that's on the line, but I am joined by some of my wonderful colleagues here at Montana Community Foundation, and hopefully we might have a chance to hear from them again and draw on their expertise when we get to the question and answer period. Speaking of expertise, that's a good time to come to our disclaimer for the day. I am not a certified tax professional. I have also never played one on television. So it's important to let you know that our presentation for today is with an educational intent only. All right, let's get going, talking about charitable giving and taxes, in particular as relates to the CARES Act. A couple of things we've all heard before. The only two guarantees in life are death and taxes. And the only thing that stays the same is change. So what does that mean for us today? It means that taxes aren't going away, but they're sure to change. And that, in fact, is exactly what they have been doing, and in particular, a lot in recent years. 2017 saw the Tax Cuts and Jobs Act. 2019, end of 2019, we saw the Secure Act. And then at the beginning of this year, the CARES Act was passed. And all of that, those tax law changes have had charitable implications, or I should say implications for charitable giving. We're going to focus in particular today on the CARES Act. It's important to note that the CARES Act, at least as things stand today, its provisions are really only in place for calendar year 2020. So come January, come the new year, we're going to revert to the way things were in 2019. I think a lot of us would like to revert to the way things were in 2019 for a variety of reasons, but for right now, we're going to have to settle for taxes. But you might also be wondering, why, if today is December 3rd, and this is all going to maybe be moot in 28 days, why are we still talking about this? Well, the answer is twofold. First, there is still time to take advantage of some of the charitable opportunities, maybe charitable and tax giving opportunities that are made available through the CARES Act before the end of the year. And also, it's my feeling that the CARES Act has done a couple of things just to focus our attention onto a couple of areas where tax planning and charitable gift planning kind of blend together. And so it's drawn our attention to some areas that we might be able, to apply going forward. So that'll be great. With that said, let's jump into talking really broadly about the provisions of the Coronavirus Aid, Relief, and Economic Security Act of 2020 that apply to charitable giving. And then after we look at them just really broadly, we'll walk through each of them one by one in a little more detail. So the Coronavirus Aid, Relief, and Economic Security Act really has three, I've listed four here, but the second or the last two are kind of similar. Really three main points that have implications for charitable giving this year. The first is it offers all taxpayers what's being called the Universal Charitable Deduction of $300 for charitable contributions. It's also suspended the required minimum distributions that folks that are 72 years or older are required to make from their IRA accounts. And then it's also bumped up, made increases to the limits on the proportion of your taxable income that can be offset by charitable gifts. And those changes have been different based on whether or not you're an individual or whether or not you're a business. With that said, let's look at the first of those, and that's the $300 universal deduction. If we have any tax gurus out there, you may know that technically it's not a deduction. I think it's actually an adjustment. It's calculated before you ever get to the place in your tax calculations where you make deductions. So if that's of interest to anybody, that's a little tidbit. But it does simply say that individual taxpayers can claim an above the line, so right off the top of your taxes, a deduction, a reduction in your taxable income of $300 for this year. So if you make any gift amount from $1 to anything over $300, you're going to be able to claim this universal deduction off the top of your taxes. That's $600 for couples filing jointly. The impact of this is really simple. There's a pretty accessible, modest incentive for anyone to give. And by incentive, I mean tax incentive for people to make a charitable gift this year. As far as what this might indicate for us going forward, while some of our examples later in the conversation are going to be more practical, this is kind of more of an abstract benefit. When the law was being put together, this deduction was actually in the $4,500 to $4,800 range, quite a bit more generous. It was obviously reduced to $300, but the way that I look at this, it seems like the fact that it was kept in there at all, especially as part of an economic relief package, is still a strong sign from the federal government that they want to encourage people to support the philanthropic sector. Now let's talk about the suspension of that required minimum distribution. As I mentioned earlier, if you don't know, if individuals who have individual retirement accounts and are aged 72 years or older are actually required to start making annual withdrawals from their IRAs. It's mandatory to begin withdrawing money. The thinking was that, the government said, okay, you don't have to pay taxes on this money. We want you to save for retirement. We're going to let you earn compound interest on that tax-free money for retirement. But when you retire, we want you to start actually spending the money and paying taxes on it. So you've got to start making those when you're 72. The CARES Act waived that for 2020. People do not have to make these required distributions. So you might be wondering what the charitable implication of that is. Well, the required minimum distributions, the RMDs, they sort of there's a charitable other side of the coin here that's called the qualified charitable distribution. So if you're 70 and a half years or older and have an IRA, you can actually make charitable distributions, charitable gifts directly from your IRA to nonprofit organizations. And so the charitable implication this year is that in a way it's, by waiving this required minimum distribution, it sort of removed the tax incentive for making those qualified charitable distributions from a certain perspective. Honestly, I think that, there might still be a benefit to making a qualified charitable distribution in this year. It's going to lower the total balance in an IRA and therefore make your required minimum distribution next year lower. So it's not totally true that it removes all possible tax benefit. It's just going to defer what benefit that might be. But, still, if you haven't been familiar with the required minimum distributions as an individual or as a representative of a nonprofit cause, likewise, if you haven't been familiar with the qualified charitable distributions, I think going forward, this is just really great information to have when you're doing some gift planning in coming years. It's a really kind of exceptional tool that people have at their disposal for making charitable gifts. So lastly, the CARES Act has also made these increases to limits related to what proportion of your income you can offset with charitable deductions. In the typical year, And really, this really only affects cash contributions. There are other limits for gifts of securities or property, but this really only affects cash donations. In typical years, you're limited to claiming deductions for charitable gifts to an amount equal to 60% of your adjusted gross income. For 2020, the CARES Act has raised that limit to 100% of your adjusted gross income. For businesses, the cap has moved from 10% to 25% of taxable income. So there's an opportunity to be able to offset even more taxes with deductions from charitable contributions. That's sort of the impact for this year. So what some people are doing, they're doing what's called bunching gifts. They're choosing to maybe make gifts, a couple of years worth of gifts, this year's and next year's worth of the charitable giving they were planning on doing. They're choosing to do that in 1 year to try and offset more taxes because this opportunity exists. Going forward, this is another great piece of information that you might be able to use when thinking about charitable giving. You know, something that's interesting, in the United States, we have a progressive graduated tax system, which means that, you know, you don't pay one flat rate of tax on all of your income. You pay one rate for the first few dollars you earn, and another rate for the next chunk of dollars, and another higher rate for the next chunk of dollars, et cetera. So an argument could be made that, you know, trying to wipe out all of your taxable income in 1 year doesn't necessarily make the most sense, because you're going to be just reducing tax at lower and lower rates. So it may make more sense to stretch out charitable giving over years, so that you continue to have tax savings at higher rates. So again, that's another sort of piece of information that might be really useful to you going forward in the future, talking with, again, qualified tax professionals. I'm just sharing information. So, you know, what have we talked about? You know, taxes aren't going away, but they are going to continue to change. And every time they change, there's a new opportunity to look at how tax, you know, a person's tax planning and charitable planning can be blended together to really try and have a maximized benefit. So that's sort of the big takeaway from all of this. These changes can definitely draw our attention to new opportunities, and hopefully just make us feel more informed and more empowered as we think about making gifts. That's what I have prepared. Does anybody, Teal, we have any questions coming through the chat box?
We did have some questions, and we got some help with answers there, but if you didn't see that, Jane had just clarified, please define a cash contribution. Check, cash, credit card donations are all okay, right? And yes, they are all okay. And then Rachel asked about, do you need to deduct the $300 above the line for your total charitable giving? Thanks for helping with the answer there, Jane. She mentioned that it only applies to people who claim the standard deduction. If people itemize, they can take the greater donation amount. Did we answer your questions there okay?
Yeah, thanks everybody. Again, we can rely on your expertise, it seems like. Thank you.
All right, and it looks like we just had another question come in from Joanne. You mentioned earlier that contributions to a donor-advised funds are not eligible. Are there any other limits to who you can give?
Okay, say that again. Teal, can you say, I can't seem to access, oh wait, here, maybe I can find the chat function.
Sure, and I can state it again for you here. You mentioned that contributions to a donor-advised fund were not eligible. Are there any other limits to whom you can give?
Any other limits to whom you can give to take advantage of the 100% AGI? Is that your question, Joanne?
I think Joanne might be referring to required minimum distribution changes. I think that's what she's talking about, Mitch.
Oh, okay. Let's see, there are a couple of limitations. Where did I put I have a couple notes that are about qualified charitable distributions. Yeah, they can't be direct.
Oh,
go ahead.
Sorry.
Oh, go ahead.
I was going to say, Mitch, this is Joanne McIsaac.
Sure.
Joanne. I think actually what Joanne either might be referring to was information when MCF sent out our CARES Act mailing in September. There was a mention that taking advantage of the 100% AGI cannot be, contributions to donor advised funds cannot count for that. And that is true. That is in the IRS's guidelines regarding the CARES Act. Additional cash contributions to donor advised funds up beyond a person's normal 60% of their AGI cannot be counted to take advantage of that 100% provision. I think that maybe, I'm not, Joanne, if that's what you're referring to, you can give us a thumbs up maybe, but I'm guessing that might be what you're asking about.
Trying to find Joanne. There she is. Joanne, was that the answer? Oh, wait, there's a thumbs up. Okay.
All right.
We just had another one come in from David, and he says, talk about how to use donor advised funds.
Okay. I think as far as, well, that's a good question. I might need more information. How to use them to take advantage of some of these tax provisions. Joanne did just mention that, you're still going to be limited to the 60% AGI if you're making cash contributions to fund a donor advised fund. So that would sort of be an exception to this increased limit that the CARES Act has presented to us all. Yeah, well, David, what else are you thinking about as far as how we use donor advised funds? And you can unmute yourself if you want, David. I think that would be fine if that's more convenient. I'm trying to find you here.
The question relates to how do you use them as far as tax planning goes?
Well, in many respects, gifts to a donor advised fund are very similar to, any other charitable giving you would do. They are, they're considered tax deductible in the same way. So I suppose, that's sort of the tax, it's a very similar tax benefit. You can deduct those as charitable contributions from your taxes. As far as a bigger picture of tax planning goes, they're not, I guess that's kind of, that's all I would have to say on that. I don't know if I'm overlooking something. It's pretty simple, as far as tax planning goes. They're kind of more designed for the charitable giving type planning, someone who's, wants to continue to be able to make charitable gifts. They want to be able to receive the tax benefits, but they might not really know to whom or how they want to direct their charitable funds in a particular year. Can sort of start to accumulate funds in a donor advised fund and then make more targeted intentional distributions or gifts from that fund at later dates. So I guess I'd also
add, I just jump in and say, David, while the subject today really is the CARES Act, I think the bigger picture story with donor advised funds is you can make a planned gift that will ultimately benefit your donor advised fund and take advantage of the Montana Charitable Endowment tax credit. And so they're a great vehicle for reducing your Montana income taxes. Beyond, the $300 conversation currently with CARES Act, it's kind of a bigger conversation in terms of your overall planning. So maybe I just offer that clarification or additional information.
Are they also useful for bunching your deductions in one year and then maybe taking standard deduction in the next year or two?
Mm-hmm. Yeah, absolutely.
And we could follow up after this call, David, and maybe talk through some specifics that you might be thinking about or questions that you might have too.
Okay, thank you.
Yeah.
Thanks, David.
Hey, Mitch, it looks like we are at the end here, but I had one more question come in. I'm hoping you can cover for us here before we shut down the webinar. Is someone reached out and asked about information that was provided in the one sheet that Joanne referenced that we sent out a couple months ago. And it's in regard to the note about the 100% AGI limit for 2020 not applying to gifts of securities or to cash donations made to established planned gifts. And really the question for planned gifts such as those qualifying for the Montana tax endowment credit. And really their question has to do with about the cash donations to fund planned gifts that qualify for the METC. So I don't know if you could talk about that a little bit.
Okay. Yeah, so a cash contribution that you used to make a planned gift that would qualify for the Montana tax credit would also generate a deductible amount that could qualify toward your 100% AGI. Now it's not an apples to apples. The federal deduction is actually reduced by the amount of the Montana tax credit, so it's not an apples to apples kind of deal. But yeah, so if you were to choose to use appreciated securities to make a planned gift, however, to get the Montana tax credit, whatever remaining charitable whatever deductible portion was remaining would be subject to that 30% limit on deductions for gifts of securities. Is that answering the question?
I just add, as we're wrapping up, if any of you have specific questions about things you're considering, or you're looking for help with, figuring out the deductibility or how a tax credit, charitable endowment tax credit qualifying gift might work, we'd be happy to follow up. We could run gift illustrations for you or any of the donors, for those of you who are nonprofits that you're working with. We'd be happy to help with that. So please consider us a resource. We aren't providing technical advice, but we're here to help you. So if you need help with understanding some of these specifically, we'd be happy to help with that as well.
And I'll just add one additional thing too, just in regard to that last question. And that is that while there isn't any specific language related to cash contributions to fund a planned gift not being able to count towards the 100% AGI within the IRS's language, the review of that concept industry-wide with financial professionals, accountants, other folks, is that it's unlikely that they will be able to qualify planned gifts, additional planned gifts would be able to qualify towards the 100% AGI, only because a planned gift is considered a quid pro quo situation where you're making a gift in return for getting something back for it. And because of that, it's a big gray area. We wouldn't want anybody to make additional planned gifts of cash, hoping that they could count them towards their 100% AGI, only to find that they're not able to. There hasn't been a final determination about that out there, but it's the sense from the industry is that it looks unlikely that they would count. So hopefully that helps with that question as well.
Any other questions? Okay. Well, thanks everyone. We really appreciate you joining us. Hopefully we've given you a couple of pieces of information you can take back and help inform you going forward.